I hope everyone is well and had a good evening. And today obviously is a significant day because it's Trumpiversary. So for those who weren't with us a year ago, I just want to quickly transition my screens. I want to show you a picture of which unfortunately Vas has been out of the office, but he's going to regret coming in because of the picture I'm about to share that happened this time last year. So let me just transition and then I'll bring it up and we can see what I'm talking about. This was last year. This is Vas here. And this is a guy dressed as a wall, the Mexican border wall. This is a bona fide suit that he bought specifically to trade the night of the US election. He came as the Mexican wall, and then of course we had to have a Mexican trying to jump over the wall to get to the American trucker. Jokes aside, this is how the evening began. I think by the time we had traded and the entire event throughout the night, people's spirits weren't quite so high at the time. But for those who are still around and watching this, yeah, pretty unforgettable night for many reasons. But a couple of questions then for you. Given it is the 12-month marker of the presidency of Donald Trump winning that election, who can tell me then, without looking and measuring on their charts, how much is the S&P up since that point 12 months ago in percentage terms? Let's have your guesses in the chat room. I'm sure any of the equity traders, you should know this pretty quickly. Okay, Charlie, very quick, impressive, 23.5%, right on the money. Okay, where does, in terms of, let me ask you this then, in terms of his performance then, the S&P has risen an impressive 23.5%. Obviously a lot of this based upon his fiscal ambitions, let's put it that way. The best performing president, though, is who in terms of an S&P return in the year following an election victory? Which US president? Any guesses with that? Come on, Bill in the chat room. Being American and having a political background, we're all going to be looking to you for guidance on this. Okay, everyone's going for Reagan, of which did do a lot of fiscal stimulus. He was the person that did the corporate tax cut, that one-off lower level in terms of repatriating flow back into the States. But the correct answer was 1944. That was the election victory for Franklin D. Roosevelt. S&P rose 36.8%. So Trump actually, in terms of a 12-month performance, as impressive as it has felt trading these markets in terms of this trend higher that we've had in US equities, actually Trump is only, in terms of a 12-month performance of the S&P rise, ranks 7th in the last 23 elections. Okay, final question then. What do you think has been the best performing asset in dollar terms since the US election? Darren, you're not wrong, but I'm not going to classify crypto and bitcoins within this in this discussion. Let's call it traditional assets then. Let me give you a hint. It was equity markets, but what country? Okay, Vas, second place. Greece was the second best performing. The best performing was the FTSE MIB. Now, I think this is probably a bit of a byproduct if you think back to September of 2016, which was before the election. this was when Deutsche Bank shares at the time were at a point of which a lot of people were questioning the long-term viability of that bank existing in its current shape or form. This is when their shares dipped below the €10 mark. That's what Deutsche trading today, roughly? Any idea? But this was when everyone was considering Deutsche being the next kind of casualty, potentially, of in assistance of a government bailout. It was that bad. And so that was the Deutsche situation, but the Italian situation was similar in respect to, it's the exact same time when the Italian bad debt accumulation crisis was kind of taking hold. The FTSE MIB was sharply underperforming, but then the government kind of stepped in, looked to consolidate the sector, backstopped with various capital injections and so on, and actually the FTSE MIB recovered very sharply since. So MIB the best. This is what it looks like. Nearly a 50% return. The Athens exchange was second, the DAX actually third, and the worst performing over this period has been some of the metals, so silver and gold amongst the least. Gold actually pretty much unchanged from where it was. Sticking with Trump then, let's get you up to date with what the latest is, and that is he obviously has wrapped up his meetings in Korea, in the south, and I remember this time yesterday I was talking about Trump was right on the screen delivering a speech and a Q&A, and I was commenting about how diplomatic I thought he was sounding. Well, that didn't last very long, because he gave a kind of keynote speech in his farewell then to that part of the East Asia region, and he basically called Kim Jong-un a deranged tyrant presiding over a cult. And that's just scratching the surface in terms of a pretty scathing speech that Trump's given about North Korea. He also called upon the likes of China and Japan to be a lot more forthcoming in helping deal with the situation. So almost a revision back to the norm in regards to how Trump has been talking about that situation. Of course, he does fly today to Beijing to meet Xi Jinping, so any commentary in regards to trade talks will be key. And just as a reference point, going back again to a year ago, well, actually it wasn't a year ago, but the last time that Trump was in Beijing with the Chinese president, if you remember, that was when, quite casually, as the reports suggest, in between dinner or in between main course and dessert, was when Donald Trump gave the go-ahead for the Syrian airstrike. It's apparently a bit of a show of force, whilst dining with one of the most powerful men on the planet. Trump wanted to make a bit of a point. Obviously there's more to it than that, but that was the timing. So quite interesting that he's then returning at this present point in time in his own anniversary of his winning that election. How has the markets reacted? Well, to that speech from Donald Trump, I don't think it catches anyone by surprise. So market reaction has been essentially zero in regard to that speech. But definitely with China now on the agenda of the next coming days before then he moves further south, this part of the tour is probably the most important. Fairly sensitive relationship that the US have with China at the moment, from North Korea to the situation on trade and so forth. So definitely needs to be monitored going through the coming day and any speeches that might come on the back of their talks. But otherwise, in terms of the actual open this morning, it's been fairly calm affair. The close on Wall Street was basically flat. Nothing too much to speak of in the Asian markets. Stocks generally mixed. Dollar slipped slightly on some of this ongoing tax reform information and likelihood the House and the Senate are going to have disagreements. So the market, if you think about it, about 2 weeks ago when we were hitting these consistent record highs in US equities, was kind of amped up on the back of the fact that we'd made pretty quick progress on the tax reform bill. However, actually it seems like it's going to go through a variety of different revisions as it goes through the separate chambers of Congress. So it's not to say I think that equities are going to fall spectacularly anytime soon. I still think that I prefer the bias to be long in US equities still for the time being, but certainly the tax reform issue is still something which we need to definitely keep an eye on quite closely. Looking at the pound though, the pound has seen a bit of movement this morning, and I just wanted to quickly have a bit of a chat about sterling. If you see here, obviously this encapsulate on this chart the big move that we had last week on Thursday with the hike but dovish then communication thereafter in the QIR and minutes. We've recovered about 50% of that move before then. We've kind of steadied here, and we actually have seen a bit of weakness this morning, so a bit of sterling underperformance. We've had a bit of a quick run on pivot, but have failed to break that more convincingly as yet. Has been a couple of news items though to be aware of that I think this isn't creating an immediate trade opportunity, but certainly is going to ratchet up the negativity, I think, for the pound in the short term. This is one. Another couple of guys in the live chat room were talking about this morning, and not that this is surprising, but this is the front page of today's FT website and in print. And so quite often what happens is that as silly as it sounds, almost a behavioural element when there's not a lot of new big headlines coming out, then what can sometimes derive market sentiment can be what is it that's being pushed in front of people's faces, this behavioural element of the way that market psychology works. And this is talking about essentially a closed door meeting that happened at the end of last week amid some of the biggest banks in the world, HSBC, Goldman's, JP Morgan, so on. And basically they've had a meeting and have told the US Commerce Secretary that Britain's unstable government and slow progress in Brexit planning may force them to start moving thousands of jobs out of the city in the near future. And obviously this would have large negative consequence for the US economy, given the financial services sector, derived predominantly out of London, is a definite key component that helps drive tax receipts and therefore net the ability for the government to function. And so certainly this type of headline story could be getting a little bit of airplay this morning, but actually I think this is probably the more bigger one. And I'm not talking about Priti Patel specifically, but what I'm talking about is the Conservative Party and this almost constant conveyor belt of issues that they seem to be having. It seems like almost every day there's a new politician with a new allegation, with a new resignation, or at least a push to fire people from Theresa May. What's quite interesting here is that no one's actually talking about Theresa May resigning now. People are talking, everyone, I think, as this timeline gets shorter of Article 50, Theresa May being replaced almost lessens, just because no one wants that job, not even Jeremy Corbyn. So, Theresa May, I don't think, is at any risk at this point of being replaced or pushed to resign, but certainly she's having to make some pretty big calls amid these scandals of senior party members, which definitely is difficult for her, because if her house is not in order domestically, very difficult then, while you're sidetracked by these issues, to then go about and deal with the transitional deal that needs to be required from the EU to safeguard Brexit negotiations for the next couple of years. If you think about it, this is almost a repeat of like with Trump and his fiscal agenda being sidelined by Russian scandals, his own advisory team making various mistakes, and so on and so forth. All this does is detract from the bigger issue at play, which is implementation of his fiscal policies. With the UK, what this is doing is this pretty much the same thing. It means that really everyone should be focused on securing this transitional deal, and yet I'm sure Theresa May is spending most of her time just trying to sort out her own cabinet at this point. And so combination of these things, I think, is important for the pound. And if you layer this then over this, which is the chart of UK inflation, I think this starts to become a little bit more negative short term. By this, what I mean is that the Bank of England's forecasts from their quarterly inflation report last week were suggesting then that inflation in the UK, of which is at 3%, we know, which is the highest in several years, is going to peak in the month of October. 3% was the September reading. So yes, it might go to 3.1 and so on, but that, as far as they're concerned, is the peak, and then actually it will revert back towards target in the long-term 2-year horizon. Now, if inflation is peaking, Brexit uncertainty is increasing, and also we saw that BRC retail sales number yesterday, which was the worst in several years, as consumers become more and more nervous about their own household health situation financially, and lose confidence, lack of spending, and so on. So if economically it's going to slow down and inflation is no longer a risk because they think then that it's now peaked, then there really is no need for any more rate hikes at this point. And obviously the next one's not priced in until well into late 2018, if not 2019. And then a second rate hike, interest rates in the UK at 1%, which, don't forget, is still relatively low comparative to historical measurement from an interest rate perspective. We're not going to be at 1% until 2020, as far as the Bank of England are communicating at the moment. So, you start putting all these things together, and I can see why the market's maybe a little bit negative this morning, sterling in particular, because there's not too much news out there, and certainly you start combining these elements. There's plenty of fundamental argument to suggest that we should be negative cable. Just to correct myself, cable is below pivot at the moment. It's tested S1. But obviously near term we'll be looking, if we go through that level, a run down to 31.23, which is the low print from yesterday afternoon session. But looking slightly longer time frame, well, let me have a look here. Then the bigger move would be the bigger level would be that 130.53, which would be the post Bank of England event low that we had last week, and you start looking at that level on a much longer time frame. This is the around the 130.50 mark, and you can see here on my chart, if I just make this a bit bigger, you've got the 130.50 level is that November low, you've got the October low, and then you've got the high from mid-July and also early May. So that's a really significant level. If we were to get down and test that 130.50 area and break, then I think odds on would be for a push down to test 130 pretty quickly, the psychological handle. But you can see there, technically, not a lot between 130 to really 128 or the high 127s area. Don't worry if you've just seen the lights go out in my video. We've not had a power cut. I'm still alive and well. One of the guys will... There you go. We're back up and running. Okay, a few other things just to get up to speed on. We've had some Chinese data overnight. Chinese trade balance. The export-import numbers actually were slightly lower than expected in yuan terms, you can see here. And that also translating in dollar terms, exports was a 0.1 miss on the year-on-year. Imports slightly higher. Nothing really too much to panic about. Certainly wasn't much in the way of any reaction at that time. Looking elsewhere, some other things to be aware of. You've had WTI crude. So this is the reaction to talk about. And obviously we had this really big run up back at the beginning of the week, which we discussed thoroughly at the time. But so it's really this area that I want to focus on. This was a downtick that was seen last night at 9:30. So this was the release of the API crude oil inventories. This was the numbers. We had a drawdown of 1.562 million. So not as large a drawdown as the markets were expecting. So a bearish headline, despite it being a drawdown, not as large as the market was expecting. Cushing a build, gasoline a surprise build, as analysts were looking for a drawdown of 1.85 million. Distillates was a draw of 3.1. So on the balance, bearish numbers. That played out in terms of a market reaction last night. However, despite bouncing back to what was actually the pivot level on overnight Asia Pac trade, we declined and retests the initial API spike low, failed to break it again, and we've come back up to pivot early this morning, only to move back and gravitating around the $57 handle at the moment. This does come after we had the OPEC World Oil Outlook report. This is an annual report, came out yesterday. This is a lot more longer time frame, but it was just quite interesting. This is the WOO is the World Oil Outlook report they issue from OPEC specifically in their research. This is looking at 2016 to 2017 and a measurement of the amount of shale production that they foresee over these coming years up to 2021. And it's quite incredible how aggressive they've had to reevaluate and increase their forecasts of shale productivity. If you look at 2021, it's almost doubling from what they previously thought just 12 months ago. The reasoning, as what we've discussed in commodity lectures, this reevaluation of the ability for shale to be much more flexible with the developments in their own technology and ability to drill and facilitate these sites much more quicker than what they had done before, has created then this new assumptions on how much shale there's going to be in the years going forward. They did actually upgrade their oil demand forecast, but actually I find this probably the least surprising, because if you think about it globally, okay, maybe not the UK having much clarity at this point, but globally, the global economy, that is continuing to improve, from the likes of China remaining fairly consistent, expansionary territory in the likes of the PMI data. Likewise, data overall has been good in the US and likewise in mainland Europe. And so no surprise, I think, that all demand forecasts are getting increased. That in combination as well with developing countries, including China and India, seeing some of the best growth rates. But I'd say that the OPEC report here, this is talking a lot more longer time frame rather than anything too immediate. All right, this is looking at the calendar for the day ahead, and this morning it's pretty quiet, and I think that's already reflected in the market prices this morning. It's been a pretty tame open, despite a little bit of movement in the sterling currency to the downside. There was a brief flurry when Europe stepped in the euro, but that's not been sustained. So really looking towards the US to guide some direction, and half an ear out for any leaks or comments that come out of the Trump discussions with Xi in China. Data-wise in the US, there's not a great deal either. Oil inventories usual time at 3:30, so you can be expecting the usual bout of volatility at that time. But otherwise pretty quiet on this side of things. Speakers though, you've got Bank of England's McCafferty, and as you all know, this is the most hawkish member of the Bank of England. Him alongside Saunders have been pushing for a rate hike for several months, and that's now come to reality. So a hawk speaking from the BOE at 4 o'clock in a radio interview, and then Bank of England's Carney giving remarks at King's College Business School. So that'll be later on this evening. So that's pretty much it. Any questions, let me know. Otherwise, have yourself a good day. Thank you very much.